Treasury mapped its refunding on November 5th. Next up, CPI on the 13th, then the Fed on December 9th and 10th. If inflation won't cool, markets can rally into a tighter corner. The path from here is set by auctions and prints. Watch the logic. The Fed eased a quarter point with inflation still above target and real yields, rates after inflation, still restrictive. Markets cheered. Funding math didn't blink. In 2007, spreads were calm in May. By August, funding snapped. The signal showed up early then too. Check the plumbing. The New York Fed's recession probability model, built from the yield curve, the relationship between short and long rates, fell from peak levels. It still sits near 3 in 10, 12 months out. That's not calm. That's pressure that hasn't cleared. The signal showed up early, again. Now the mechanism works like this. Coupon, the fixed interest rate on a bond, set near 2 during 2020 to 2021, is rolling at 4 to 5 by 2026. Rollover, refinancing old debt with new debt, raises the interest bill, even if principal doesn't grow. Term premium, the extra yield investors demand for holding long bonds, stays sticky when buyers want compensation for risk. The result? Time gets expensive. Picture this for a second. It's like refinancing a mortgage at double the rate while income is flat. The payment changes before the paycheck does. Follow the money. The Treasury mapped its next quarterly refunding for November 5th, 2025. Auctions set the price of time. Auction tail, when demand is weak, forces yields higher to clear supply. Primary dealers, the banks required to bid, can warehouse only so much. When they hit limits, tails widen. Why does that matter? When tails widen, everyone downstream pays more for time. Look at the banking lens. The Senior Loan Officer Opinion Survey shows standards for business credit tightened through the third quarter.
Demand from large and mid-market firms firmed. That's a costly mix. Banks lend with thicker cushions. Firms still want cash. The result? Investment slows first, hiring second. Translation? The jobs engine coughs before it stalls. Check this contradiction. The Fed eased on October 29th. Unemployment estimates rounded to roughly 4 2/5 by November 6th. That's easier policy into a softening labour tape. In 1989, the curve steepened off an inversion while unemployment rose. The lag fooled people. Then came recession. So far, policy got easier as labour cooled. Coming up, why markets can rise while the base erodes. The numbers prove a split economy. Equity indexes gained into late October. Credit conditions stayed tight for new borrowers. Real yield, the interest rate minus inflation, remained positive across long maturities. That's rare when growth runs hot. It fits a different story. Markets are pricing liquidity, not a durable boom. Picture the bridge. It's like a house party with strict door staff. The room looks packed because no one leaves. New guests wait outside. Now the pressure builds. Treasury's net interest outlay crossed into the territory where debt service competes with large program lines at points this year. Each 1 percentage point higher on term structure ripples through agencies, municipalities, and corporates. Maturity wall, when lots of debt comes due at once, arrives on a schedule, not a headline. Here's why it matters. The calendar can't delay itself. Watch the timing. The New York Fed's yield curve model peaks roughly a year before unemployment peaks. When the model falls, unemployment usually crests, then drifts lower. Today, the model is easing from high ground without a confirmed recession print. That hints at a plateau, not a boom. Stability feels better than contraction. It can still hide fragility. The result? The baseline improves. but shock sensitivity stays high. The pattern emerged across cycles.
In 2001, tech investment led the expansion. The Fed tightened into strength, then cut as the shock arrived. Unemployment climbed for months after the first cut. In 2007, housing credit masked stress. Cuts began, Labour lagged, the snap came later. So far, falling model odds without a full recession echo older mid-cycle turns. Coming up, the three signals that decide whether this turn holds. Follow the money across borders. The European Central Bank held policy high into autumn, while the Bank of Japan defended a fragile yield framework. Divergent central banks move capital. When Europe stays firm and America eases, the dollar can soften without solving US issuance needs. Foreign official buyers still weigh real yield and currency risk. Translation? Not every buyer returns just because policy is easier. Look at corporate behavior. Large platforms spent well over $100 billion combined this year building artificial intelligence infrastructure. That spending leans on bond markets. Spreads, the gap between corporate and Treasury yields, didn't blow out. They didn't normalize either. Issuers grabbed windows. Buyers demanded concessions. The math says funding stays available, but at a toll. Analogy time. It's like using a toll road that never discounts. The drive is smooth, the price keeps rising. Check this contradiction. Stocks price a clean glide path. Bank standards show a slower path. The gap is time. Markets pull the future forward. Balance sheets pay current prices. What changed? The Fed signaled it will slow balance sheet runoff, letting bonds mature without replacing them, faster than expected, by December 1st. That shifts marginal demand toward treasuries. It doesn't erase supply. Treasuries still must fund the large fiscal deficit when government spends more than it collects. That's the constraint. So far, marginal buyers return, but supply doesn't shrink. Coming up, the calendar that decides whether the soft plateau sticks. Watch the next 3 dates. On November 5th, 2025, Treasury lays out refunding sizes and maturities. On November 13th, 2025, the October Consumer Price Index is slated for release, shutdown permitting. On December 9th to 10th, 2025, the Fed meets again with fresh projections. Picture the stakes. 3 dates decide the next move: supply scale, inflation pace, and policy stance. Notice the contradiction. Easing policy plus steady real yields means liquidity moved, not structure. The signal was hiding in plain sight. The curve steepened as the Labour tape cooled. Check the timing on this. Balance sheet runoff slows before the biggest maturity walls. Follow the money on this. Banks tightened while firms asked for more credit. That's when pressure builds. Auctions must clear as foreign demand wobbles. The mechanism emerged. Cuts soothe psychology, not arithmetic. Now the core question. Does the plateau bend higher or slip? Warning sign 1 in 60 seconds. Refunding tails. If the 10-year and 30-year auctions consistently tail, long rates rise to attract buyers. That feeds mortgage and corporate funding costs. The soft plateau then hardens into slower hiring. Break it down. Dealers bid. Indirects nibble. If both hesitate, the tail appears. Prices fall to clear. Warning sign 2 in 2 minutes. Real yields rising while the dollar drifts. That means investors want extra pay for time even without a currency fear. It tightens global financial conditions. It also raises discount rates on long-dated projects. Investment cools. Warning sign 3 near the end. Standards stay tight in the next loan officer survey while delinquencies creep. That pairing slows small firm hiring. It also weighs on commercial real estate refinancing. Local shocks then travel. So far, 3 concrete tells point to stress under calm prices. Coming up, who the players are and what each will try next. Follow the players. The Fed will frame December as data-dependent, with risk now balanced.
It will lean on the idea that Labour has cooled enough to justify patience. One more cut is possible if inflation permits, but balance sheet adjustments may do more work than rate moves. That's the quiet lever. The Treasury will balance coupon sizes against market depth. It can lean more on bills to ease long-end pressure for a quarter. It cannot bill finance a lasting gap. The issuance mix signals how much pain it is willing to shift out the curve. Banks will ration credit where collateral is weaker and spreads are thin. They will meet demand from top-tier clients at a price. They will protect capital into year-end. That slows the pass-through of easier policy to the real economy. Analogy time. Think of a 4-lane highway. The Fed opens an on-ramp. Treasury adds trucks. Banks narrow a lane with cones. Traffic moves, it doesn't fly. Check this against history. In 1998, policy cuts and support operations calmed a funding storm. The real economy avoided a deep recession. In 2001, cuts couldn't outrun a capital spending bust. The real economy sagged for quarters. Today's setup blends both: heavy investment plus large public borrowing. The rhyme is there, the verse is new. Now the mid-script cliffhanger. If the November 5th refunding tilts long and tails widen, the spike seen in late October won't be the last. If the November 13th CPI holds above 3 with sticky core, the December easing path narrows. If both occur, the plateau fades. So far, policy has room, but the calendar bites. Coming up, the near-term path if those dates break either way. Watch what happens if the 3 dates go favourable. Smaller long-end sizes, a calm CPI, a cautious December. The curve steepens gently. Real yields edge lower. Standards ease in the next survey. Unemployment stops rising. Markets hold gains. Watch what happens if they turn adverse. Bigger duration supply, a hot CPI, a reluctant December. The curve steepens the hard way. Real yields lift. Standards stay tight. Unemployment inches higher. Markets churn. The constraint is simple. The United States needs to fund large deficits while it cools inflation without breaking labour. Europe must manage growth with less policy room. Japan must defend a fragile structure while the yen searches for balance. Flows move to where real yield and credibility align. Here's what that means. The world prices time, not stories. Bring it back to the motif. The signal showed up early when the model rolled off peaks. It showed up early when standards stayed tight into an easier Fed. It will show up early in auctions if demand hesitates again. Small cracks, big breaks belongs to a different motif. Today's belongs here. The signal showed up early. 3 dates, 1 story. November 5th, November 13th, December 9th to 10th. Supply, prices, policy. Before we close, take the promised dashboard. Auctions, firm or soft? Watchtails, cover ratios and indirect bids. Real yields, rising or falling. That sets the global price of time. Central bank flows, adding or pausing. Balance sheet runoff direction matters. The signal showed up early. The course of history just changed because time got repriced.